Okay, let's unpack this. We're closing out 2025 with a truly pivotal year-end financial report. This is the Vivimoney Daily snapshot from December 31st. And our mission here is to go beyond just the price tickers and really distill the core, the structural characteristics of this environment for you. So what defines this? It's really this uncomfortable convergence of thin seasonal liquidity and a profoundly divided Federal Reserve.
That synthesis it's exactly right.
Oh.
I mean, if you boil down the last few weeks of 2025, you're left with those dynamics. The seasonal liquidity tightness layered right on top of profound internal Fed disagreements.
Right.
And for anyone, planning their strategy for 2026, understanding the friction between those two forces is it's absolutely critical.
Let's dive straight into that friction then, starting with the macro context, specifically interest rates, because the long end of the curve is certainly not playing ball with the rate cut optimism we hear so much about.
It's a stubborn reality check.
Yeah.
The U.S. 10-year Treasury yield is sampled around, 4.12 to 4.14% in this closing window?
And that's high.
It is, and that figure is more than just a number. It dictates the discount rate for all future cash flows. By staying this high, it creates significant ongoing upward pressure on risk asset valuation.
Yeah.
The cost of capital is elevated.
Which means every growth stock is fighting a headwind.
Every single one. And while that long-term cost is high, the short-term operational reality really highlights how much the system still relies on the central bank's, financial plumbing, just to say smooth.
You're talking about the passive use of the short-term liquidity tools.
This is where we shift from market sentiment to the mechanical reality. We saw the Fed's short-term liquidity mechanisms, the overnight reverse repo, the on-RRP.
Right, and the standing repo facility.
Exactly. Both were utilized passively right up until year-end, and we saw a notable jump in activity on December 29th and 30th.
Okay, so for our listener, the why matters here. Why is the passive use of the RRP an important indicator?
Think of the RRP as a massive parking lot for excess cash. When financial institutions, especially money market funds, have nowhere profitable or safe enough to park their dollars overnight, they put it into the Fed's RRP facility.
Okay.
So passive utilization tells us that despite those high long-term rates you mentioned, there is still significant excess liquidity just sloshing around the system. The private sector isn't fully absorbing it.
A jump at the end of the month.
That just emphasizes that when seasonal month-end liquidity tightens, institutions still lean on the Fed's facility. It's a critical safety valve. It's an operational necessity, not some choice driven by aggressive monetary policy.
So we have this high cost of capital on one side, excess operational liquidity on the other, and it's all overseen by a central bank that just can't agree on its next move. The December Fed meeting minutes, they really delivered market uncertainty in spades.
Oh, they confirmed the worst fears for anyone looking for a clear policy path. The minutes showed a clear internal division among Federal Reserve officials about the timing, about the scale of potential 2026 rate cuts.
So the market's pricing in cuts, but the Fed itself isn't sure.
The market's aggressive, but the policymakers are split. Some are arguing for patience, others for preemptive action. That creates enormous policy risk. I mean, you can't build a sound long-term strategy when the foundational policy direction is so internally contested.
That division makes the next variable even more interesting: volatility and risk sentiment. The VIX, the traditional market fear gauge, it looks deceptively calm, hovering near 14.20.
Deceptively is the key word.
But if you look at digital assets, the mood is completely different.
And that divergence is critical. It tells us exactly where the current stress points are. The low VIX reflects relatively low equity volatility. And that's largely because the concentration in the S&P 500 and the NASDAQ is so narrow, so focused on these massive, stable AI leaders.
Yeah.
But then you cross-reference that with the crypto fear and greed index.
Which is where?
It remains stuck in the fear or even extreme fear range. We're talking 20 to 30. You see the anxiety there.
Okay, so why the split? Why are traditional tech stocks so serene while digital assets are, in panic mode?
It comes down to liquidity and policy sensitivity. Crypto assets are just far more sensitive to thin liquidity and policy expectations. They thrive on risk appetite. When the Fed is internally divided, it creates these huge swings in dollar expectations, and that directly impacts leveraged crypto trading.
While the equity market is insulated.
It's insulated by the sheer size and dominance of a handful of companies whose growth thesis AI transcends these minor rate jitters. The market is functionally two-tiered right now: insulated mega-cap growth and then all the exposed risk assets.
That brings us to a major tailwind that really defined 2025. the performance of the US dollar index, the DXY.
The DXY is sampled around 98.2 to close the year, but the context here is everything. This level represents a massive year-to-date decline of approximately 9.5%.
9.5%, that's huge.
Dollar weakness was the macroeconomic story of 2025. And this wasn't just a curiosity, it was a powerful lubricant, a massive tailwind for international assets, emerging markets, and especially for anything priced in dollars, like commodities.
So a weakening dollar makes everything else look relatively more valuable.
Precisely. And that DXY decline, that 9.5% drop, was a huge factor in driving capital into assets that protect against fiat currency dilution.
Which brings us perfectly to where the market excitement really was at the end of the year. Core asset performance.
Exactly. Let's start with the anchors. VOO, tracking the S&P 500, is sampled near $632. QQQM, the NASDAQ Q100 tracker, is near 255 to 257, and the trend remains unmistakable. AI and semiconductors are the engine room.
But the individual stocks in that engine room, they seem to be telling very different stories about investor risk appetite.
They absolutely are. Look at NVIDIA. NVDA, sampled near 187 to 190. Its narrative is pure infrastructure.
The shovels for the gold rush.
The shovels for the gold rush. Its growth is tied to concrete capital expenditure. Now, contrast that with Tesla, TSLA, sampled around 454, 455. Tesla's price is less about steady quarterly metrics and more about, well, faith. Faith placed in high future expectations, specifically the success of robotaxi applications.
So the market's still willing to pay a huge premium for an expected future.
Even amid a divided Fed, yes. It shows that risk appetite hasn't vanished, it's just highly concentrated, very narrative-driven.
We also saw some major corporate maneuvering right at year-end that solidified that AI mandate across multiple sectors.
The M&A activity was instructive. You had Meta acquiring Manus, a cutting-edge AI startup that's clearly signaling their push into more generalized AI, consumer agents, going toe-to-toe with the other big players.
And Alphabet?
Alphabet is still a fortress. It's supported by its core advertising machine, which continues to fund its massive and sometimes very expensive AI research.
And then there's Coinbase. They made a move that really seems to define the transition we're seeing in the digital space.
Their acquisition of the prediction market startup, the clearing company, is fascinating. It's Coinbase basically saying, we are not just a crypto exchange anymore.
It's the beyond crypto narrative.
Exactly. They're driving that diversification, looking for new revenue streams that leverage their tech base, but aren't purely reliant on Bitcoin spot volatility. It's a strategic pivot.
Okay, moving into that purely digital sphere, the prices are strong historically, but the sentiment we discussed, that extreme fear, is tangible, especially with the thin year-end volume.
The nervousness is palpable, yeah. Bitcoin, BTC, is near $88,495. Ethereum, ETH, is near $2,975. And Solana, SOL, is closing out around 125, 126. These are historically impressive levels, but the lack of liquidity means small trades can have a huge impact on price. That's where the anxiety comes from.
And for the subset of our audience focused on, let's say, the truly niche, high-risk speculation, let's just touch briefly on the pre-stocks shares in those private AI unicorns.
Right. This is a segment for sophisticated investors, and we're talking very small positions. These assets are illiquid, they're unregulated. We see dramatic price differences depending on the platform, and you're seeing ranges of, say, 180 to 320 for Anthropic pre-stocks, and a similarly wide range of 1,050 to 1,150 for OpenAI pre-stocks. That massive price variance is your flashing warning sign. It's pure narrative-driven speculation.
All right, let's pivot entirely now, because while AI and semiconductors dominated the conversation, the biggest market performance story of 2025, the one that really surprised global markets, was in the oldest asset class we have.
We are talking about the precious metals surge, the necessary hedge when everything else feels so uncertain. Gold had its best performance in nearly 45 years in 2025.
45 years?
It broke historical records, reaching a peak price of $4,549 an ounce before we saw some year-end profit-taking. It's monumental.
That's extraordinary, especially in a year where tech stocks were also hitting all-time highs. It's like the market was hedging against two entirely different outcomes at the same time.
It was the ultimate dichotomy. Gold's surge wasn't fueled by economic optimism. It was fueled by precisely the two macro factors we started with: policy uncertainty from the divided Fed and the significant weakness of the US dollar. When the central banker's roof is leaking, investors run to the oldest, most reliable safe house. And in 2025, that was gold.
But gold wasn't even the wildest rise. Silver stole the show in terms of sheer percentage gains and volatility.
Silver was truly the surprise star. It delivered an annual gain exceeding 150%. It touched an historical high of over $80 before its own correction began.
Why silver, though?
Well, it's often called poor man's gold, but it also has crucial industrial applications, so it benefits both from the geopolitical hedge narrative and from anticipated economic demand. That combination, amplified by dollar weakness, just created a perfect storm.
And this incredible performance in metals shifted a crucial relative valuation metric: how gold stacked up against, say, digital scarcity assets like Bitcoin.
Precisely. That strength led to the BTC gold ratio declining significantly compared to the start of the year. For much of the decade, Bitcoin was touted as the superior digital gold. But 2025 showed that when faced with deep systemic uncertainty and fiat weakness, the traditional physical hedge, it demonstrated superior relative strength.
So it forces us to ask if gold is reasserting its dominance.
It does, as the premier hedge against monetary instability.
Okay, so after looking at this really complex picture: high rates, excess liquidity, a divided Fed, narrow AI leadership, a historic precious metals surge, what is the consolidated strategic meaning for you, the listener, heading into 2026?
The overarching strategic takeaway from all this is clearly defense first. You anchor your foundation with the broad established indexes VOO and QQQM. Then you layer in strategic exposure to those core AI leaders like NVIDIA, Meta, and Alphabet. They provide growth, but also stability.
And given the spectacular volatile performance we just discussed in the metals market, where do those physical assets fit into a defensive strategy?
They are essential insurance. Precious metals are the necessary hedge against both policy uncertainty and potential inflation from all that systemic liquidity. Holding gold ETFs or physical metal provides crucial diversification. Silver, while it delivered enormous gains, remains highly volatile, so it's more suitable for shorter-term, strictly risk-managed speculation.
And for those playing in the exposed high-risk realms like crypto and those pre-stocks?
Strict discipline is paramount. Small position sizing and non-negotiable stop-loss management are required. While BTC and ETH are consolidating at what could be attractive long-term levels, that extreme fear sentiment dictates extreme caution in the short term.
That brings us back full circle to the central banker risk. The entire market strategy seems built around managing risk caused by the Fed's own internal uncertainty.
It does. The core variable for 2026 is less about, whether inflation hits 2% or what the unemployment rate is. It's about how the market reacts to operational shifts in those passive liquidity tools. The RRP and standing repo, coupled with that explicit documented internal split within the Fed.
Because the market has become reliant on this specific low volatility environment that's being maintained by these liquidity cushions.
Exactly. And this raises the important question you have to track. What happens when the Federal Reserve finally finds a definitive policy consensus for or against cuts, and then decides to explicitly draw down those liquidity cushions? How exposed are highly leveraged short-term risk assets to a sudden unified policy signal? That emergence of consensus, regardless of its direction, could trigger volatility far greater than anything we saw in the equity markets this year. It's the policy pivot that poses the greatest systemic threat.